Hello and welcome back. My name is Connor Tumblin. I serve in the investment committee here at the Retirement Guys Formula. And today I'm going to be sharing with you one of our favorite strategies called protected equities. But first, here are our disclaimers. And if you'd like, you can take a minute and pause the video and feel free to read through all the disclaimers that we have. Now for an overview of protected equities. This is a protective growth portfolio designed to limit downside risk in exchange for a capped upside. It utilizes buffered ETFs to meet this goal, and we'll explain what buffered ETFs are later in this video. And options are the main investment vehicle in this portfolio. So not actual stocks or bonds, but this case is actually options. The risk score for the portfolio is 55, which is about a moderate risk level. And this is an objective metric generated by the software Riskalyze. So this number is based on the level of potential downside risk that the portfolio faces, and it ranges from 0, which would be very safe, to 100, which would be very risky. So at a 55, we're pretty much right in the middle. So here's why I like this portfolio. Owning equity in American companies is one of the most reliable ways to increase your wealth in the long run. We have seen this to be true for centuries, and up to this point, the market has recovered from every disaster from the Great Depression to COVID-19. And although a full recovery is never a guarantee, the better question is how long it'll take for the market to recover, not if it'll recover. But what if you want to invest in these cutting-edge American companies, but you don't have time to recoup your losses from an unforeseeable event like the COVID crash? Protected equities might be the way to go for you. By using this portfolio, you get exposure to the S&P 500, which is 500 of some of the biggest American companies, but you can avoid large and sustained losses that might destroy your retirement. On the flip side, you can only capture a limited amount of gains. If you're fine with this trade-off, then protected equities might be the portfolio for you. So now let's talk about these buffered ETFs in the portfolio. How do these work? We'll start more generally first. So the prices are based on an index's performance. In this case, the index is the S&P 500. It utilizes an option strategy on the index to limit downside risk in exchange for a capped upside. So it'll be buying and selling call and put options, which either do well when the market goes up or it does well when the market goes down. This combination of buying and selling put options allows for this defined outcome. So there are 3 different levels of risk tolerance among the different buffered ETFs that this portfolio holds. And these different risk tolerances affects the size of the upside cap, the size of the downside buffer, and the participation rate of realized losses. And these all work together, these 3 things. So for example, if you have a higher upside cap, this is going to be in exchange for a smaller downside buffer, smaller downside protection, in other words. So now here's an example of one of the ETF's possible outcomes, one of the ETFs in this portfolio. So let's say that this is a July buffered ETF. So on July 1st of this year, it'll begin tracking the S&P 500's performance. And this outcome period goes until next July 1st. So from this July 1st to next July 1st, if the S&P 500 goes up 10.3% or more, then this ETF will capture 10.3% of this index's upside over the next year. It's also protected from the first 15% of declines if the S&P 500 was to drop over this next year. And then after more than a 15% drop in the S&P 500, the investor who is holding this buffered ETF will continue to take losses. So for example, if the S&P 500 is down 30%, you are going to lose 15% in just this buffered ETF. But these figures don't take into consideration management fees or expense ratios, but these aren't going to be too significant for you. So here it is visualized now to get an even better understanding of how these work. So again, this is only for a single buffered ETF in the portfolio. This is not the entire portfolio, but this is how one of them would work. So say we have a major market decline and the S&P 500 drops 30%. We're looking right here. You're buffered on the downside. So you would only be taking a 15% loss holding this buffered ETF. Say there's a large market decline now of 15%. This is your buffer level. You can withstand 15% of the losses in the market without taking any losses in the buffered ETF. So if the market drops 15%, the buffered ETF is flat. Now for a mild market decline, if the S&P 500 only drops 5%, the buffered ETF is still flat. Now on the upside, if the market was to grow over the next 1 year period, if the S&P 500's up, say 5% right here, then the buffered ETF will also be up 5%. You get to participate in this growth. Now say we have a really good year. Say it's the year 2020 after the COVID crash. Say the market grows 15%. We'll say this is 15%. I'm not quite sure how much this actually is, but you only get to participate in this capped amount. So this would be this 10.3% line here. You only get to participate up to this level. Now, it is very important to understand that all of these things, the buffered ETFs will behave this way only if you buy it on July 1st, which is when the buffered ETF outcome period begins and then ends the next year. If you buy it somewhere in the middle of the year, you are not going to experience these exact results, most likely. So now moving on for more of the portfolio statistics. These numbers are generated by the software Riskalyze again, and they represent with 95% certainty the likely range of returns over the next 6 months using historical data. So again, say it's the year 2020 when things were going very well, or 2021 even, this portfolio might be up as much as almost 18% over the next 6 months. Or on the downside, say it's the first 6 months of 2022 when markets have been very rocky with rising interest rates and inflation, this portfolio might be down as bad as almost 11%. And again, this is only a 95% probability. So this doesn't take into account the crazy outliers like the COVID crash. This portfolio has a 0% annualized distribution rate, so this would not be a good income portfolio. And it has an expense ratio of 0.93% on an annualized basis. This does not take into account the management fees that you pay to your advisor, the Retirement Guys formula. So the key takeaways for the protected equities portfolio. This is great for those who are near retirement and would like to participate in some of the market's gains, but also want to hedge against these big losses. It's a moderate risk level, and it utilizes derivatives to achieve this goal. So finally, let's get in touch. If this portfolio is of interest to you, or if you have some questions on it, I would encourage you to reach out to the professional who showed you this video, or you can call us here at the Retirement Guys formula at 419-842-0550. Our headquarters is located at 1700 Woodlands Drive in Maumee, Ohio. So again, thanks for joining us. I'm Connor Tumblin here from the Retirement Guys formula, talking about the protected equities portfolio. Have a great day, and we look forward to getting in touch.